Welcome to The Explainer. Okay, so today we're looking at this absolutely wild paradox unfolding right now in enterprise tech. I want you to imagine a massive $68 billion tech giant delivering a stellar first quarter earnings report. I mean, totally crushing expectations and generating a decade-high cash flow. Now, margin the market's response to all that undeniably good news is to just panic and immediately send the stock tumbling. Well, there's no need to imagine it because that is exactly what happened to IBM in Q1 2026. And today, we are going to decode this mystery.
Here is our roadmap for today. First, the Q1 earnings disconnect. Second, cash flow and acquisitions. Third, the Watson X AI catalyst. Fourth, consulting versus software margins. And finally, we'll wrap up with the bull versus bear outlook.
All right, section 1, the Q1 earnings disconnect. Let's jump right into the raw numbers that left so many analysts scratching their heads. So here's the core mystery we really need to solve today. IBM drops its Q1 2026 results, and honestly, by almost every traditional metric, they hit a home run. But then, out of nowhere, the stock takes a sudden 6% nosedive, dropping roughly 22% year-to-date from its previous highs. We are seeing a massive, glaring disconnect here between the company's incredibly strong underlying fundamentals and the narrative-driven anxiety that's currently gripping investors. So what exactly were those numbers? Well, the numbers were literally outstanding. We're talking $2.2 billion in first quarter free cash flow. That's not just a solid quarter, guys. That's their best Q1 free cash flow result in an entire decade. And on top of that, they grew revenue by 9% to reach $15.9 billion. They beat on revenue, they beat on earnings per share, and they are generating cash at a historic rate. Moving right along, section 2, cash flow and acquisitions. Because we really need to see how IBM is actually using this massive influx of capital, because it certainly isn't just sitting around collecting dust in a bank account. Now, I want you to notice this idea of the flywheel. James Kavanaugh, IBM's CFO, made a huge point of emphasizing that their $5.2 billion in net operating cash flow year to date provides, as he calls it, tremendous investment flexibility. See, this cash is a highly active strategic tool. It allows IBM to restructure, fund quantum computing R&D, and just straight up buy category-leading companies to bolt onto their existing infrastructure. And we can actually see that flywheel in action right here. That massive cash generation directly funded their $11.6 billion acquisition of Confluent back in March of 2026. Basically, by bringing Confluent in-house, IBM is making sure they can provide seamless, trusted data flow between enterprise environments. And that is the exact plumbing required to deploy AI safely and quickly. Okay, section 3, the Watson X AI catalyst. Let's look at how that newly acquired infrastructure feeds directly into IBM's most powerful growth engine. Just take a second and let this number sink in. $12.5 billion. That is the size of IBM's current generative AI book of business. Think about that. This isn't speculative hype and it's not beta testing revenue. No, these are locked-in consulting and license agreements from actual Fortune 500 companies. Plus, analysts are projecting this book of business is going to scale rapidly to $15 billion by 2027. IBM is monetizing AI right now at massive scale. So why are all these massive enterprises flocking to them? Well, it's because IBM isn't out there building some consumer chatbot to help you write a high school essay. They are building a heavily regulated enterprise-grade governance stock. The Watson X architecture basically has 3 main pillars. First up, WatsonX.ai, which allows companies to train custom models on their own strictly proprietary data. Then there's WatsonX.governance. This ensures compliance, safety, and explainability, which, by the way, is absolutely mandatory for sectors like banking and healthcare. And third, WatsonX.data, which optimizes the massive data lakehouses required to even run these models in the first place. They own the governance and integration layer, and that is a massive, massive competitive moat.
And, this kind of transformation doesn't just happen overnight. As CEO Arvind Krishna points out, this has actually been a very deliberate 7-year pivot. They saw the commoditization of the interaction layer coming miles away. They knew that as AI agents start replacing human interaction, the real sticky value for enterprises would be in the underlying data and business logic layers. IBM basically skated to where the puck was going, and that foresight is clearly paying off in that $12.5 billion book of business.
Which brings us to section 4, consulting vs. software margins. If the AI strategy is working so brilliantly, what on earth is terrifying Wall Street? Let's dig into the hidden pressure points.
IBM right now is basically a tale of two different businesses. On one hand, you've got the software segment. This is your highly profitable SaaS, with gross margins sitting around 60.6%, and it's quickly approaching half of IBM's total business. On the other hand, you've got the consulting segment. Margins over here are quite a bit lower, generally around 35 to 40%, and they're currently under some serious macroeconomic pressure. But here's the catch. Actually, it's the whole crux of the issue. Right now, over 80% of that massive $12.5 billion AI book of business is being driven by this lower margin consulting segment. They're the ones doing all the heavy lifting of early AI integration.
Look, Wall Street is notoriously impatient, but management actually has a really clear transition plan here. They are actively evolving IBM into an intellectual property-based business, ultimately targeting 80% of the total portfolio. So the key execution metric we all need to be watching is whether they can shift that AI revenue mix. Can they drive software up to 40 or 45% of the AI book by the end of 2026? Because if they pull that off, margins are going to absolutely explode upward. And the best part? While investors wait for this whole thing to play out, IBM pays you for your patience. They recently raised their dividend to $1.69 per share, maintaining a streak of over 30 consecutive years. Wall Street might have the memory of a goldfish, but IBM is very clearly playing the long game.
All right, final section, number 5, bull versus bear outlook. Let's see how all this hard data translates into Wall Street's asymmetric risk and reward models. When we look at the analyst targets, the optimists like JP Morgan, they've got a bull target set at $360. They're basically betting that IBM's AI governance moat is highly defensible, that Red Hat hybrid cloud adoption is going to accelerate, and that the big shift to software will unleash some massive margin leverage. Now, on the flip side, the bears are targeting $218. They're fearing a structural decline in consulting margins and the looming threat of open source AI eating into IBM's market share. But I want you to anchor your attention on that middle line. The consensus target of 13 different analysts is $318.92. They're seeing a reasonable 15.2 times forward PE valuation, a super safe 2.71% dividend yield, and very real Watson X catalysts.
So the setup right now paints a really fascinating picture. With the stock hovering around 245 at the time of these reports, there's actually a pretty limited drop-down to that 218 bear case. That downside is fiercely protected by their massive cash flow, that low 15.2 PE ratio, and of course that reliable dividend. But look at the upside to that $360 bull case. If IBM successfully pivots that AI book of business over toward high-margin software over the next 12 to 18 months, the upside potential is tremendous. It is a classic asymmetric risk-to-reward scenario. Which brings us to the final thought I really want to leave you with today. We've looked at the decade-high cash flows, the strategic acquisitions, and that staggering $12.5 billion demand for Watson X. We've also talked about the very real margin pressures in consulting that are totally spooking short-term investors. So you really have to ask yourself, as IBM sheds its legacy skin to become the undisputed leader in enterprise AI governance, is this current market impatience actually your greatest long-term opportunity? Well, now it's up to you to weigh the evidence. Thanks for joining me on this explainer and keep questioning the narrative.